The market has just been absolutely resilient. Several macro factors are more favorable than not. We've seen a decline in the 10-year yield.
We know the correlation that stocks don't bottom till after the 2-year peaks, but in this environment it's clear the equity market is looking at the 10-year benchmark rate. We see the 10-year peak coincide with the October lows and the lower high coincide with the break and support of the bear market trend.
Having a banking crisis concern around recession, the BBB spreads have been able to continue their downward ascent.
When BBB spreads spike, that's a signal that investors are moving out of riskier corporate bonds and into risk-free US Treasury bonds.
They have not been rising. That's good news.
Now, as that spread narrows, it tells you investors have an appetite for risk, but the real question is why. The cost of capital is falling, investors are underweight risk, growth is falling but not collapsing, and inflation is trending lower on every year-over-year metric.
People aren't listening closely enough to the message of that market.
But if oil breaks out and earnings collapse,